Today is the 19th of June 2020, and I'm here today with another live recording of how I manage my option trading portfolio and also my thought process that I go through when I'm about to enter a new trade. We are looking right now at the daily chart of the SPY, and if you are here with us for our last live market analysis on the 14th of June, you would have known how I've said the 302 level and the 294 level to be strong support for the prices of SPY. And if the prices are continue to be supported by the 302 level, I will initiate a long position on the SPY. Alternatively, if the SPY broke through the 302 level and come back down to test the 294 and show a rebounds, I will also initiate a long position on the SPY. So sure enough, on Monday when the market gapped down, I was waiting for it to reach the 294 level. But on that day itself, markets were relatively bullish. Instead of going down, it kept going up instead. So once it broke above the 302 level and showed signs of prices being supported at that level, I went ahead as planned and then initiated a long vertical spread on the SPY. Or in other words, you can call it a bull call spread on the SPY. What I've done is I've bought a $305 strike long call on SPY, and then I've sold a short call on 320 strike, both expiring on the same expiry date, and that is on the 19th of July. So basically what I'm saying is that if the SPY can stay above 305, I'll be in the profit, and my max profit will be achieved when the SPY reaches a target of about $320 by the expiration of the bull call spread. And if we go over to analyze the trade that I've made, this will be the risk profile of the trade. For the entire trade, my break-even price will be at $311, and my max profit will be reached when the SPY closes on the 18th of July at a price of about $320 to $321. And for that, my max profit will be about $822 as seen by the numbers over here. And likewise, this trade has cost me $678. My max loss will be achieved when SPY drops to a low of $303 by the day of the expiration. But of course, like I've always said, I will never allow myself to reach the max loss. I'll close the trade when I see my losses reach about 2% of my account, and that will be about $300 over dollars. So if we mouse over to find that price right now, you can see that I would have suffered a loss of $300 over dollars if SPY could fall to $290 by today. And that is highly unlikely because as I've said earlier, 294 have shown to be a rather strong support, and if the SPY were to break the 294 level, I'll immediately close out this trade for an even smaller loss. Okay, so my plan for this trade would be to hold on to it for as long as possible, and hopefully SPY can reach the target of about $320 by mid-July. Alright, so the first trade that I would like to go through today would be the Intel calendar spread, which I've turned it into a diagonal spread if you have been following my live session. So previously, I've sold a short dated call option on Intel at a strike price of $64, and right now Intel is currently at 59. So this call is going to be expiring worthless. And since this call is going to expire today, we have to close out this short call or either let it expire worthless. And at the same time, to initiate a new short call according to the strategy. So if we go over to the daily chart of Intel, previously Intel broke above the resistance of about $61 and then subsequently went up to about $63 to $64. And that is when I covered my $60 strike short call and initiated a new short call at a strike of 64, thinking that Intel will slowly continue to go up. And that is the main basis of why I turned my calendar spread for Intel into a diagonal spread. But who knows that shortly after we have initiated that short call at $64 strike, Intel subsequently broke through this support level again and then found support at about $58, which is the 150 SMA as seen over here. And currently, Intel is at $59. And back then, I was still considering to sell this $60 call and maintain my Intel trade as a calendar spread, or to sell a higher strike at $64 and turn this calendar spread into a diagonal one. So on hindsight and retrospectively, it would have been more profitable for me if I've kept it as a calendar spread and just sold the $60 strike call instead. All right, by selling the $60 strike call, I would have lowered my cost of this trade to $250, but instead I take the other option, which is to sell a higher strike, and that increased my cost of trade to about $5. Okay, let us go over to the option chain and consider our options once again. So if you recall, when selling the short dated strike, we want an expiry of about 30 days to expiry. So the 10 July expiry is definitely out, as 21 days is too short, and we are left with 17 July and 24 July. So out of these two, I'll prefer the 17 July one, as it has a date to expiry of 28 days. Just nice, close to the 30 days that we are looking out for. So with the current prices of Intel, I will be going ahead with the $60 strike call. And currently $60 strike call is going at about $195 to about $198 each. Okay, so with that, let us analyze what will happen if we take on this position. So to do that, I would like to right click on this current position that I'm holding. And then to duplicate that, I would like to click on Analyze Trade again. And then just uncheck the first one, change the criteria to the one that we will be holding. And that will be on the 17th of July, selling a call with a strike of $60. And for that, we will be earning, let's say we manage to sell this call option at $2 each. And that will bring down our cost of the trade to $3. Okay, so let's analyze our risk profile. For this date, we want to set it to the date of expiry, and that will be on the 17th of July. All right, the next thing we want to do is to see our break-even prices. And from the chart, you can see that our break-even will now be set to $57.50, about there, and about $62.90. All right. At expiration, if the stock price of Intel can stay at $60, my max profit will be $122, and my max loss would likewise be $300, which is my cost of the trade. Okay, so the next thing we want to see is where does our break-even price fall on the chart. If we go over to the chart, $57.50 will be somewhere below this 200 simple moving average, and that should be rather safe for us, as the 200 SMA tends to be the strongest line of defense for stock prices. All right, and as for our upside, our break-even prices will be at $62.90, and that would be somewhere around here, $63, which is also rather close to our resistance. We can draw somewhat of a strong resistance at this area over here, and that would be about $64. So 63, $62.90 will be very close to the resistance. And we can also see from the corner of the chart that Intel is about to release its earnings on the 23rd of July. But our short options expires on the 17th of July, so that will be before earnings. And before Intel reports its earnings, my guess would be that Intel would remain to trade within this tight boundary over here. So with that, I'm going to go ahead and execute this short call on my trading platform. So I'd like to go over to my options tab and then key in Intel. So we will be looking at an expiry of 17 July and with a strike price of $60. So we want to be selling a call for that. So I'll just click on the red button and you will lead the position into the order entry box. Okay, so currently $60 call option contract for Intel expiring 17 July is going for $2.10 to $2.14. So I'll just set a sell limit at the midpoint and then just submit my trade. And meanwhile, I'll be waiting for my order to get filled. Okay, while waiting for our orders, let's go through my other positions in the account.
Order filled.
Alright, you can see that the order has been filled for Intel. So my other positions on my account would be a diagonal spread on Activision Blizzard, and for that I have a short dated sold call with a $77.50 strike that's expiring on the 17th of July. So there's still some time away. And currently Activision Blizzard is at $75.77. So still quite a distance away from my short call. So that's fine. The next position, Bank of America. For the Bank of America diagonal spread over here, you see that currently I've sold a short dated call expiring on the 2nd of July with a strike price of $29. And $29 is currently rather far away from the current price of Bank of America. Bank of America right now is going at about $24.80. And for this, you can see that the bulk of the profit from this call option could be realized. I've sold these calls at about 400 total, and currently they are only going at market value of about $40 total. I've already achieved about 90% of the max profit, and if I want to, I can either close it and initiate a new short position, or I could just wait it out for it to expire on the 2nd of July, which is still quite some time away. So let's look at my options for the Bank of America. So this is the daily price chart of our Bank of America. I've identified somewhat of a narrow upwards trending channel for the Bank of America, and you can see that the upper boundary of the channel has been respected so far pretty well. Once it broke out, it found support, but the support is not strong enough and it broke through afterwards. So currently it is at a price of about $24.70. So what I want to do is to go over to the option chain and analyze my possibilities. So currently my trading position is expiring on the 2nd of July with a strike of $29 call, and that is going at about 13 to 14 cents each. And these options still have 13 days to expiry. What I could do is to cover this and then sell a call option with a further out expiry, maybe on the 17th of July, and that still has 28 days to expiry. And for that, I could consider either the $25 strike or the $26 strike. Okay, so $25 strike seems a bit too near for comfort right now. Perhaps we will look at the 26 strike instead. Okay, so this is the trade log for my Bank of America trade. Currently, the cost of my Bank of America trade is at $3.64 for the whole trade. So let's analyze what would happen if we were to sell the call that's expiring on 17 July with a strike of $26. Currently for 17 July, it is going at about 92 cents to 95 cents each. If we factor in the premium that we have collected, that will bring down the cost of my trade to about $2.72. Okay, so $2.72 is for the cost of the entire trade. And since I'm trading 3 contracts of BAC, I will have to divide this by 3. And that will give me about 91 cents, all right? So on the Think or Swim platform, the cost here is for per contract of the trade that you are trading. So we have to key in appropriately 91 cents. And this will be my risk profile for the trade. If Bank of America stays at $26 by expiry, you can see that my max profit will be $770. And if it goes up to infinity, I will still have a max profit of about $620 over dollars. And my break-even price would be at $21.70. And if it falls further than that, my max loss would be $273. So, which is a rather good deal for me. Currently, you can see that I've indicated a horizontal resistance at about $26.50. So my guess again would be that prices will be rather restricted during this period, and at least it should not go above $26.50. But let's see what is going to happen, and then manage our trade again accordingly. So with that, I'm going to initiate a new position for my Bank of America again, and I'll be selling 3 contracts at, let's say, 94 cents. Okay,
Order filled.
and once again, you see that the order has been filled almost instantaneously. And at the same time, I would also like to close out my current position, that is my short 29 strike call on the BAC as well. And for that, that is currently going for about 12 cents to 14 cents each. So let's go for maybe 12 cents. Okay, let's continue and go down the list of my positions. The next in line would be EEM, and for that I have a short call expiring 2 July with a strike of 40.5, and EEM currently is at $40, so there's still room for it to move before we have to manage it. And then next would be Intel, that one we have just managed, and then followed by Microsoft. So Microsoft expiring 10 July, a short call of $195. It has already exceeded, but the delta should not go beyond zero point 0.8 yet. Let's just double check. So 10 July, still 21 days to expiry. 195 call is currently having a delta of 0.54. So we can still allow it some room to run. When it reach a delta of about 0.7 to 0.8, then we will come and roll this short option contract out and up. Lastly, for TSM, I have a short call at 56 strike expiring 2 July 2020. And for TSM, currently the price is at $55.50. So still some room to run before we have to manage the trade again. Meanwhile, it seems like today has been a rather bearish day for the SPY. After all, it's a Friday, there could be some profit taking. But we should see that this support level at about 308 should hold. If it breaks on Monday, Then the next level to look out for will be again the 302 and the 294. All right. Likewise, I myself as an option trader, I'll be monitoring the broad market closely, and if the SPY shows any signs of bearishness or possibility for any strong downward move in the near future, I will have to take my hedge against the market and protect my profits. So for those of you who are wondering how I'm doing right now, my portfolio is currently up 39% year to date as compared to the SPY, which has barely broken even. That is already quite satisfying to me, and my small personal goal for the first half of 2020 will be to reach an NLV of 20,000 for my trading account. And hopefully by the end of the year, I would be able to close with an NLV of 25,000. And that should add about 25% to my current portfolio performance right now. So if you're interested in the actions that I'm going to take to reach my small little goals, be sure to subscribe to the channel and pay attention to these little updates that I upload onto the channel. And also keep a lookout for our Facebook page where I post small little notes or some small little actions that I've taken along the way, as well as occasionally there will be some mini market analysis being uploaded onto the page as well. Alright, last but not least, I'm going to execute a new trade on Starbucks. So Starbucks recently have announced that they are going to close up a few hundreds of their stores. And with the current situation going on, my take would be that their growth would be slow during this period. And with that, I have an intention to execute a calendar spread for Starbucks. So first, let's do some technical analysis on the daily chart. I can see somewhat of a support and resistance at the $72 level, which is somewhere around here, right? You can see that at this level, it has been resisted a few times back in the past and then also acted as a support for quite a few times during this recovery period from April to June. So currently, Starbucks is trading at $75.17. So let us take a look at our options. So when initiating new trades like a calendar spread, we want to ensure that the current IV is low because we will be a net buyer of options. So current IV percentile is at 24%, so less than the 40%, and that is considered okay. And when initiating a calendar spread, I would like to look out for a long dated call option contract and own it, and at the same time sell a short dated call option contract. So for our list of option chain right here, I see that the 16 October 2020 expiry is the best suited for our case. It has a date to expiration of 120 days, which is between the 3 to 6 months expiry that we are looking out for. 15 January would be slightly too long for my comfort, so I'll just stick to the 16 October. And as for our short dated call option contract that we are going to sell, I will be looking at the 17 July expiry with an date to expiration of 28 days. With that, let us expand those chains and look at our strikes. The strike interval for Starbucks is going at 250 each, 72.50, 75, and 77.5. Okay, so let's just take up the $75 strike and I'm going to sell it. Next, for our long dated call option contract, 16 October. Likewise, we are going to buy and own a same strike price call option contract. So I'm going to hold on to the control key and then click on the buy price. And there you have it. It is now in the order entry under Think or Swim. In summary, for this trade, we will be longing a 16 October expiry call option contract with a strike of $75 and shorting a short dated call option contract expiring 17 July 2020 at the same strike $75. This trade would be going for $3.10 per contract. Multiply by 100 shares, that would be $310. Right click, go to Analyze Trade to look at its risk profile. So I'm going to close out the irrelevant ones and just left with the current one that we are interested at. The first thing to look at would be our break-even prices. We have for this trade a break-even price of $69 and $81. So where are these on the chart? $69.75, that is somewhere around $70, and that will be about here. Previously, I've already drawn a support at $72, so that is way above our break-even price, and we should be rather safe, cushioned by this support level over here. And as for our upper boundary, that would be at about $81. So $81 is rather close to the 200 SMA, which is at this level right here. And we do not see any earnings coming up for Starbucks. So barring any unexpected events from the general market out there, we should be able to see Starbucks trading in a rather narrow range within this boundary for some time. And therefore, I would say that this trade would be rather safe and profitable for us. So at expiry, which is the 18th of July, you can see that we would have made a max profit of $223 if Starbucks stayed at $75. And likewise, our max loss would be $310 if Starbucks increased above $81 or fell below $70. And from the daily chart, we have seen that these two levels are beyond our support and resistances for the prices of Starbucks. So we should be rather safe staying within this boundary. And the software even analyzes that your trade has a 47%, close to 50% of staying within this boundary. And there is a 24% chance that Starbucks might shoot above $81 and also 28% chance that Starbucks might shoot below $69.75. So with that 50% chance to make 200 with a max loss of $300, that would be a rather attractive deal to me. And if this short call that we sold expire worthless, we could always sell another one and use the premium collected to cover and refinance for the cost of our trade. So with that, I'm going to execute this trade and let's continue to monitor and see how it goes. On my trading platform, which is the Interactive Brokers, I'll go over to options and then key in Starbucks. I want to enable the strategy builder and then set my expiry to the one that I'm interested. That will be the 17th July and the October 16th with a strike of only $75. So I'm going to sell the short dated one and I'm going to long the long dated one. Check back on Thinkorswim for the latest price is going at $3.03 each. So let's see if we can get it for $3. Double check that everything is going according to plan and transmit. All right, the price has risen to 305 now. So it's all right then. Let's just set it at market rate and let's hope and wait for it to be filled. Let's increase slowly. Okay, the strike, the bid and ask, they are in increment of 5 cents each. In that sense, let's raise it up to 310 or maybe 315.
Order filled.
All right, it's filled at 313. Okay, so there you have it. Let's continue to monitor this trade and see how it will progress. And that's all for today's video. Thank you so much for watching. And as always, do remember to smash the like button and as well as subscribe and turn on the bell notification. Thank you once again, and I look forward to seeing you in the next video.